If you're going to be an investor, it's really one of the most valuable assets you have today as someone who's 18 or 19 years old is your youth. You want to start early so that your money can grow over time. Let's talk a little bit about the psychology of investing. So we've talked about some of the technical factors, how to think about what a business is worth. You want to buy a business at a reasonable price. You want to buy a business that's going to exist forever, that has barriers to entry, where it's going to be difficult for people to compete with you. But all of those things are important, and a lot of investors follow those principles. The problem is that when they put them into practice, and there's a panic in the world, and the stock market's heading down every day, and they're watching the value of their IRA or their investment account decline, the natural tendency is sort of to do the opposite of what makes sense. To be a successful investor, you have to be able to avoid some natural human tendencies to follow the herd. When the stock market's going down every day, your natural tendency is to want to sell. When the stock market's actually going up every day, your natural tendency is to want to buy. So in bubbles, you probably should be a seller. In busts, you should probably be a buyer. And you have to have that kind of a discipline. You have to have a stomach to withstand the volatility of the stock market. You know, a lot of people talk about risk in the stock market as the risk of stock prices moving up and down every day. We don't think that's the risk that you should be focused on. The risk you should be focused on is if you invest in a business, what are the chances that you're going to lose your money? That there's going to be a permanent loss. When you're thinking about investing your own money and you're thinking about one investment versus another, don't worry so much about whether the price moves up and down a lot in the short term. What matters is, ultimately, will you get your money back? Will you earn a return on your investment? How do you think about risk? One way to think about risk is to compare your risk to other alternatives. So you can buy government bonds, and government bonds are considered today the lowest risk form of investment, and the US Treasury issues 10-year, 3-year, 5-year debt. There's a stated interest rate, and today a 10-year Treasury, you earn about a 3% return. So you give your government $1,000, you get $30 of your interest. At the end of 10 years, you get your $1,000 back. So how do you avoid the riskiest investments? My advice would be to invest in public security, invest in listed companies, companies that trade on the stock market. Why? Because those businesses tend to be more established. They have to meet certain hurdles before they go public. The stocks are liquid, so you can change your mind if you want to sell. If you invest in a private lemonade stand, it's hard to find someone to take you out of that investment unless that business becomes fabulously profitable. So that's piece of advice number one. Invest in public companies. Number two, you want to invest in businesses that you can understand. What I mean by that is there are lots of businesses that you deal with in the course of your day and your personal life, whether it's a retail store that you know because you like shopping there, or it's a product, your iPad, or that you think is a great product. But you have to understand how the company makes money. The business is just too complicated. You don't understand how they make money. Even if they've had a great track record, I would avoid it. And a lot of people thought Enron was an incredible business because it appeared to have a good track record, but very few people understood how they made money. It was good to avoid it. Another very important criteria is you want to invest at a reasonable price. It could be a fabulous business that's done very well over a long period of time, but if you pay too much for it, you're not going to earn a very good return. The last bit is that you want to invest in a business that you could theoretically own forever. If the stock market were to close for 10 years, you wouldn't be unhappy. What do I mean by that? Now, again, if you're going to compound your money at a 10 or 15% return over a 43-year period of time, you really want a business that you can own forever. You don't want to constantly have to be shifting from one business to the next. Let's assume at 22 you get a pretty good job. Instead of spending your money on gadgets or a fancy apartment or not so fancy apartment or going out and drinking a fair amount, you put some money aside, you start investing money. Let's say you could save $10,000 at 22 and you can earn a 10% return on that money between now and the time you retire. What would you have in 43 years? The answer is you put aside $10,000, you don't save another penny, and you invested it and you earn 10% on your money each year, you'd have $600,000 in year 43. And the reason for that is, well, in year one, your $10,000 would become 11. In year two, your $11,000 would grow by 10%. And so you'd be earning interest, not just on your original principal, but you'd earn interest on the interest you'd earned in the previous year. And that compounding effect allows money to grow in an almost exponential fashion. Now, obviously, if you earn more than 10%, you can earn even higher returns. Now, that's if you put $10,000 aside in 22, have $600,000 in 43 years, that's pretty good. What if you had to wait until you were 32? The problem there is, by year 33, you'd only have $232,000. Maybe that's not enough to retire. So a key thing here is, if you're going to be an investor, it's really one of the most valuable assets you have today as someone who's 18 or 19 years old is your youth. You want to start early so that your money can grow over time. What are the key things to look for in a business, as I say, that lasts forever? We want a business that sells a product or a service that people need and that is somewhat unique, and they have a loyalty to this particular brand or product, and that people are willing to pay a premium for that. If you're investing for the long term, you want to invest in businesses that have very little debt. So if you can find a company that can earn attractive profits, doesn't have a lot of debt, they generate vastly more profits than they need to pay the interest on their debt, that's a safe place to put your money over a long period of time. You want businesses that have what people call barriers to entry. You want a business where it's hard for someone tomorrow to set up a new company to compete with you and put you out of business. When you're thinking about choosing a company, make sure that they sell a product or a service it's hard for someone else to make a better one that you'll switch to tomorrow. You also want businesses that are not particularly sensitive to outside factors, so-called extrinsic factors that you can't control. So if a business will be affected dramatically if the price of a particular commodity goes up, or if interest rates move up and down, or if currency prices change, you want a company that's fairly immune to what's going on in the world. And you can be confident, based on the history, that this is a business that's going to be around almost regardless of whether interest rates are at 14%, whether the US dollar is not worth very much, or the price of gold's up or down. Those are the kind of companies you want to invest in the long term. Businesses that are extremely immune to the events that are going on in the world. Best businesses are the ones where they don't require a lot of capital to be reinvested in the company. They generate lots of cash that you can use to pay dividends to your shareholders, or you can invest in new high return, attractive projects. I guess the last point I would make is that you're invest in public companies. It's probably safest to invest in businesses that are not controlled. The problem with a controlled company, unless the controlling shareholder is someone you completely trust, unless there's someone that has a great track record for taking care of so-called minority investors, the non-controlling shareholders, it can be a risky proposition to invest in that business because you're at the whim of the controlling shareholder. And even if the controlling shareholder today is someone that you feel comfortable with, there's no assurance that in the future they might sell control to someone else who's not going to be as supportive of the shareholders of the business. So it's not that you can simply have a profitable business and a business that has done well. You have to make sure that the management and the people that control the business think about you as an owner and are going to protect your interests. So these are some of the key criteria to think about. Now, when are you ready to start investing money? My guess is you're a student, you probably have student loans, perhaps you even have some credit card debt, you're going to graduate, you're going to get a job. So you don't want to jump right in and while you have a lot of debt outstanding, start investing in the stock market. The stock market is a place to invest when you have money you can put away and you won't need for 5 years or maybe 10 years. So if you're paying relatively high interest rates on your credit cards, you definitely want to pay off your credit cards first before you think about investing in the stock market. Your student loans are probably lower cost than your credit cards, but again here, my best advice would be, if your student loans are costing you 6 or 7%, well, if you pay them off, it's as if you earned a guaranteed 6 or 7% return. And you're just better off getting rid of your credit card debt and even your student loan debt before you commit a lot of material amount of money to the stock market. Even once you've paid off your credit card debt, perhaps you're paid down your student loans, you want to have enough money in the bank so that even if you were to lose your job tomorrow, you've got a good 6 months, maybe even 12 months of money set aside. Let's say this is just not for you. I don't want to buy individual stocks. It just seems too risky. I don't have the time to do my own research. What are your alternatives? Well, your alternatives are to outsource your investing to others. You can hire a money manager, or you can hire a group of money managers. And there are a couple of different alternatives for a startup investor. The most common alternative are mutual fund companies. So what's a mutual fund? A mutual fund is I guess technically it's a corporation, but where you buy stock in this corporation and the manager selects a portfolio of stocks. So what they do is they pool together capital, money from a large group of investors. So let's say they raise $1 billion, and they take that money and they invest in a diversified collection of securities. Now the benefit of this approach is that with a tiny amount of money, you can less than $1,000, you can buy into a diversified portfolio managed by a professional manager who's compensated to do a good job for you investing in the market. So mutual funds are a good potential area for investment. The problem is there are probably 7,000, 8,000, maybe 10,000 different mutual funds, and some are fantastic and some are not particularly good. You need to do research to find a good mutual fund manager.